There's this really cynical idea that you hear sometimes, that war, for all of its horror, might actually be good for the economy. But is there any truth to that, or is it just a grim myth? Well, today we're going to follow the money and see what the data actually tells us.
So this is the thinking, right? That somehow, in the middle of all that chaos and conflict, there's this silver lining of economic growth, a ton of new jobs, and super fast innovation. It's an idea that really sticks around, but does it actually hold up? So let's get right to it. Is this view actually backed up by the facts? Can war really be a positive for a country's economy? To figure that out, we're going to dig into research that covers hundreds of conflicts over the last 2 centuries.
Okay, so to really get to the bottom of this, we have to start by understanding the case for war as an economic booster. Where does this whole idea even come from?
The logic kind of goes like this, in 3 basic steps. First, the government starts pouring huge amounts of money into the war effort. We're talking everything from weapons to soldiers. Second, all that spending creates jobs and can really ramp up productivity in factories. And third, the intense pressure of war can spark incredible technological innovation, what some people call learning by necessity. Think about it. The research for the atomic bomb ultimately gave us nuclear power.
And the textbook example, the one everyone points to, is the United States during World War II. The American economy didn't just grow, it exploded. In only 5 years, it expanded by a jaw-dropping 72%. This one statistic, more than anything else, is the pillar holding up the whole war is good for business idea.
Okay, but here's the thing. If you only look at that one example, you're missing the most critical part of the story. Because the moment we look beyond that specific American experience, things start to look completely different. And this is the absolute key. The United States is a total outlier. For more than 150 years, its biggest conflicts have all been fought thousands of miles away. But for most other countries, that's a luxury they just don't have. For them, war is something that happens at home. And believe me, that one difference, it changes everything. Because when a war is fought on a country's own soil, the economic story completely flips. Instead of growth, you get devastation. On average, these nations see their GDP per person actually drop by 9%.
And a 9% drop might not sound like a lot, but to put that in perspective for you, it's more than double the economic hit the U.S. took during the 2008 financial crisis. We're not talking about a little recession here. We're talking about a truly catastrophic shock to the system.
So, where does all this devastation come from? Well, it goes way beyond just one number. It turns out the real economic scars of war run deep, they last a long time, and they affect a society in so many different ways.
First off, you've got the human cost. An economy, at the end of the day, is its people. War shrinks your workforce through casualties and people fleeing as refugees. But it also casts this huge shadow over the future. Birth rates just plummet, and you can see that disruption in the data for years and years after the fighting stops.
Then there's the physical stuff, the actual capital, the very things that make an economy run. Factories, farms, roads, equipment. They often get destroyed. Trade just collapses. And with all that risk and uncertainty, money, it flees the country. Both foreign and local investors want out.
And trying to recover from all this, well, it's a long, painful road. Just look at this. For half of the countries that had a war on their own turf, the economic damage was still there 25 years down the line. Only about a third managed to get back on their feet within 5 years.
Okay, but what about the so-called winners, the countries that don't have fighting on their own soil? Well, even they don't get off scot-free. To pay for a war, national debt just goes through the roof, and all of that new government spending almost always triggers painful inflation back home.
So it's pretty clear the broader economy takes a massive hit. But what about the stock market? That's got to be where the money is made, right? Well, this is where things get a little more convoluted.
If you look at the U.S. market, it's actually proven to be amazingly resilient. After the initial shock from a crisis, it tends to bounce back really fast. After 9/11, for example, the S&P 500 clawed back all its losses in just over a month. Pretty incredible.
But here's the catch. Bouncing back from a short-term shock is one thing. What about performance during a long drawn-out war? Well, as you can see here, there's just no predictable pattern at all. You've got negative returns in World War I, positive in World War II, and since then, it's basically a coin toss.
So, what does this all tell us?
Well, it means that even if a few defense companies see their stocks pop, that's like looking at the economy through a keyhole. It completely ignores the widespread economic damage and shows that for the market as a whole, war is definitely not a reliable path to profit.
All right, so when you put all the evidence together, the verdict is just crystal clear. The idea that war is good for business isn't just wrong, it's a dangerous myth that flies in the face of overwhelming evidence. For most nations, most of the time, war is an engine of economic destruction, not growth.
So the data really couldn't be clearer. Those supposed economic benefits of war, they're the exception, not the rule. The costs, however, are widespread and just devastating. Which brings us to one last, really important question. If war isn't good for business overall, who exactly is paying the economic price?